Hey there. Welcome to another episode of the Back Channel. And this episode, it's July 2023. People are trying to decide what to do with fundraising. And I wanted to give a couple notes on what it means to prepare to fundraise in this market. This won't be an exhaustive list, but I did want to touch on a few important points that I think founders need to embrace if they are going to try to raise capital while we're still in a down market. So the big thing to note over the last year is how soft the markets have gotten and how risk averse investors have been. When you think about VCs in general, we're talking about risk reward, comfort levels versus opportunities. And in a bull market where money was cheap, it was easy to put dollars out there, and it was more about deploying capital than it was about underlying risk. You would see a lot of VCs skip steps. You would see a lot of VCs assume that the investments that they took on were certainly risky, but they could use the money to learn and iterate. We're in a state right now where there is very little acceptance for skipping steps, and the level of comfort that VCs need in order to do a deal is quite high. Now, AI startups are a completely different category. This is a segment of the market whose levels of excitement are high enough where VCs are going to take more risk as they put money to work there. If you're not in AI, the bar for you to activate a VC to make an investment in you is quite high. So to do that, you have to think about what it means to de-risk the opportunity for an investor. So what does that mean? When a VC is looking at an opportunity, let's call it a very early stage deal, maybe it's pre-product or initial MVP. What they are thinking about in their head is, okay, what are the next steps? What are the next things that the founder is going to have to do? Now, can you do as much as possible to de-risk what they believe is necessary? For example, if you're building a software platform that does X, as much as you can do to show, one, that you can build. So what does that mean? Well, one, it means actually building something and showing someone that you can build. And then two, that you're working on something that is an actual problem, that is something that customers would actually want. When it comes to de-risking an opportunity, it's all about validating the problem that's being solved and validating the team that's building the solution. If you're a startup trying to sell into enterprises, I'm sure you've been dreading getting some sort of certification like SOC 2 or HIPAA. I know I did when I ran my last startup, and it cost us a lot of important deals. Well, you're in luck because not only is there an awesome solution called Vanta that makes the process dead simple, but also funded listeners get $1,000 off their service just by going to vanta.com/funded. Check it out. On the problem side of things, as I was talking about the YOLO nature of the bull markets in 2021, in those situations, VCs were throwing money at ideas and early stage products that had little to no validation, kind of in the back of their heads, knowing that maybe they haven't validated everything, but we're going to take a bet here. We're going to hope that these people figured out that they do the right things and get to the next level. In this market, though, VCs want to see that the market problem has been validated. So what that means is going as far down the path of talking to customers, engaging with customers, even selling customers as much as possible before you talk to investors, because you really need to convince them that you validated the opportunity. Gone are the days that VCs are just going to assume that you'll figure that out. Secondly, can this team do it? Well, what are the early stages of can this team do it? There's a product motion, there's a marketing motion, and there's a selling motion. So on the product motion, can this team actually build and build quickly? Well, you need to show examples of your ability to do that. Obviously, the more that you can do, the better, but figure out what it is you're able to do before you have to raise capital and get as much of that as you can done. So that means actually launching a product. That means iterating quickly. That means showing your cycle of development as being quick and agile. So do as much of that as you can. And then on the selling and marketing side of things, do you know how you're going to get distribution? Do you know how customers are going to find you? If you do, well, show investors that you know what that motion looks like. On the marketing side, do you have an audience? Have you been able to build an audience? Can you get people to even consider your product? And then on the selling side, and this is very important, if you're doing anything that looks B2B, show people that you can sell. Show people that you have the wherewithal to go out and sell the first $100,000 of customers. Even if it's not actual dollars in the door, show that you have that motion, your ability to go reach out to opportunities, find leads, close leads, even if they're LOIs or indications of interest. All these things are going to go very far in making VCs comfortable with you in a market that is putting comfort at a premium. So just a couple things for you to consider as you look to raise money in a down market for the rest of 2023. We'll talk a little bit more about different tactics and things that you'll want to focus on in future episodes of the Back Channel. I'll see you next time.